Hello everybody, and once again welcome to Sinhanomics, the money machine. Last time I started the new series called the Investing for Beginners, and I got good response there. So I'll go further and talk about the other topics that I promised earlier. So today I'll just talk about the index, all the different indices of the world, how they are created and what do they mean. I think most of you who are new in this investing world must be wondering, what are these indices? What's Dow Jones Industrial Average, and then S&P 500, and in other countries like in Australia, what's Australian All Ordinary Index. If you are in India, the two prominent ones are the Sensex and the Nifty 50. So I'll talk a little bit about that and also teach you how to create an index. That will give you a good understanding of the whole indices as well as how you can create an index for yourself. Well, let's start with the Dow Jones Industrial Average, which is the most widely followed index in the world. So again, as I had talked about it earlier as well, all these indices are actually the representation of certain number of stocks when we are talking about the stock market. So Dow Jones Industrial Average actually has 30 companies in there, the top 30 companies of USA, and kind of is almost the oldest index that's being tracked today. It actually started in mid 1880s. Yes, you heard that right, mid 1880s, and it was kind of created by Charles Dow, who was the co-founder of the Wall Street Journal as well as the Dow Jones and Company, and that's why the name it has been named after Mr. Dow. It's called Dow Jones Industrial Average. Well, it's called industrial because at that time there was industrial revolution that happened, and that's why all the indices initially didn't have 30, but all those companies were representing some industries. Well, later on the other segments have also been included there, and right now today as it is, it actually represents the top 30 companies of USA. Again, when it was started in mid 1880s, its value was around 62 or something, and right now, as you know, it's pretty much trading at around 36,000. So having said that, there has been continuous changes in this index, because as and when a new company goes up and increases in its size, they have to change that, and the same story goes on for any other index in the world. The other very widely tracked index is S&P 500, which is a representation of 500 top companies of US, and many investors actually track that as a true representative of the stock market of US because it represents 500 companies as compared to 30 only in the Dow Jones Industrial Average. So you can actually see that different indices have different number of stocks there. Well, another one which is very widely tracked is the NASDAQ index, and more specifically NASDAQ 100, which has 100 companies, and this NASDAQ 100 was created in January 31, 1985. Yes, it's very recent actually, and this actually comprises the IT companies, technology companies. And right now, as I mentioned, when any of the index actually starts, gone are the days we are not comparing that with 1880s index creation, but now in the modern world, any index that you create has to start with 100, because if it goes down, if it goes into the negative territory, it will not become negative. If you start with say 0 or 1, it can become negative, right? So to avoid that, it is actually it starts from 100. So NASDAQ 100 basically was started in January 31, 1985. When we talk about the Australian market, the Australian All Ordinaries Index, which was started in again January 1980, was the most tracked index, and later on when S&P introduced, and now it's called S&P ASX 200, that's actually the index of the top 200 companies, and that's pretty much trading at around 7,300, 7,500 guys. When it comes to India, as I was mentioning, there are two most prominent indices are there. One is from the Bombay Stock Exchange, BSE, and the name of the index is Sensex. And That was started in 1980. So that started with 100 and right now it's sitting at around 66,000. Yes, you heard that right. 66,000. So if you had invested 100 rupees in India in 1980, right now that value would have been 66,000 rupees. Another one, when the new stock exchange opened in 1992, that's the National Stock Exchange in Delhi, another index was created and that was Nifty 50. That's actually an index of 50 stocks. Unlike Sensex, which is pretty much replicating the Dow, that's an index of 30 stocks, top 30 companies of India based on the market capitalization. Similarly, Nifty 50 is actually the top 50 companies of India based on their market capitalization. Again, just like S&P 500, Nifty 50 is actually most widely tracked because again it has 50 stocks and also the volume of the transactions is much higher than that of the Sensex. Well, there is slight difference which I'd like to highlight here as well between the Dow. Unlike the other indices of the world, which is based on the market capitalization, Dow Jones Industrial Average, which is the 30 largest companies, it's a price weighted and not market cap. So the slight difference there. Anyway, let's not get into that nitty gritty. The main idea here today is to introduce you to what are these indices. So well, coming back to the Nifty 50 that I was talking about, it started in 1992, again with say 100, and now it's trading at around almost 20,000. Yes guys, if you had invested 100 rupees in 1992 in Nifty 50, right now you'd have been sitting at 20,000 rupees. That's how you can actually see. And these indices are actually the replica, is kind of a proxy to see how the market is moving. So if the index has moved 10%, you can say stock market has gone up by 10%. If it's going down by 10%, you can say the market has dropped by 10%. And that's the purpose of these. Otherwise, it's very difficult to gauge how the whole market is going up or down. And that's the purpose of all these indices. Well, I'll not go into the different other indices of the world. You can actually look at that. Again, within one stock market, there are multiple other indices. And I'll give an example here. For an example, say Nifty 50 in India. Now they have Nifty Bank Nifty. It has all the banking stocks. It has Nifty IT Index. It has Nifty FMCG Index, fast moving consumer goods, and so on. Similarly, in Australian market, you'll see multiple of them, ASX 200, ASX 20, ASX 50, and all those kind of things. But the major indices which I talked about are the ones which are being tracked, and they represent to a large extent the overall market. Well, I had talked about in my previous video that some of you, if you know how to create an index, because that's really important, that it must be coming to your mind that, hey, how these indices are created. Of course, they are representing like 30 or 100 or 500, whatever it is, but how do you create an index? And I'm going to talk a little bit about that also. And with a very simple example of buying fruits, for an example, you can create your own index. If you have your own portfolio, say your portfolio has 10 or 20 stocks, you can create an index of those 20 stocks as well. So basically, you can track those 20 or 30 or 10, whatever is in your portfolio on a regular basis, and you can say my portfolio is increasing by X% or decreasing by X%, Y%, whatever it is. So guys, let's a little bit talk about how to create an index, and I'll take a very simple example. When you go to do a shopping, say for the fruits or for the vegetables, I think we all do that, right? So I'll take an example of the fruit here. So suppose you went today to buy fruits and you bought 5 different fruits or 4 different fruits, whatever you can take it. For simplicity, let's take 4. So you buy apple, oranges, pear, and banana. Let's talk about these 4. So you went to the market and you bought 1 kilo of apple, 1 kilo of oranges, 1 kilo of banana, and 1 kilo of pear. And you actually spent, say, for simplicity, I'll say $100. Of course, this looks a bit higher, but let's put it for there for making it even simpler. Guys, so today if you went there and spent $100 in these 4 fruits, and for simplicity I'll use 1 kilo each. Now your total cost today is $100. Now as I told you, you have to divide that by a denominator to reach to 100. In this example it became simple. It became like you have to divide that by 1. So 1 becomes your denominator, and that will be fixed. Again tomorrow or a week later, you went there and bought again 4 different fruits, 1 kilo each, 1 kilo apple, 1 kilo banana, 1 kilo pear, and 1 kilo orange, and the price today is $105 for an example. Now remember the denominator you had to bring it to 100. In this simple example it's 1. So now you'll divide 105 by 1, and your index next week is 105. So anybody, and you yourself can say that, hey, the overall price of the fruit has gone up by 5%. Again, the following week you went there and you found the fruits cheaper, and again you bought the same quantity of these same 4 fruits and you paid only $95. Again you divide that by the denominator 1, in this case it's 95. So your index is now 95. So if you plot the graph, it will be 100, week 100, week 205, week 395. So that's how the index is created. If 101 is kind of confusing you, let's take another example. Let's take an example of something else which adds to 200 for an example. The only thing you have to remember is the stuff that you are purchasing has to be the same and the quantity has to be the same. So in this case, if you are going and buying 5 kilo of apple, 5 kilo of banana, 5 kilo of pear, 5 kilo of orange, and the price comes as 500 for an example. Now you have to bring 500 to 100 to start the index. So you will divide that by 5. So unlike the previous example where the total for 1 kilo was 100 and you had to add the denominator of 1, here because you have changed that and you are going to continue with 5 kilo each, your total value is 500, and now to bring it down to 100 to start the index, you have to divide that by 5. So 5 is your denominator, which will be constant. So guys, 3 things have to be constant in an index: the products, their quantity, and this denominator. So in this example, 500 divided by 5 is 100. That will start your index. Again you went there next week, you purchased the same fruits, the same quantity, and the price came as 520 for an example. In this 520 you will divide that by the denominator, that was 5, and that comes as 104. Now your index is 104. The following week you went there and the price you paid for all these fruits with the same quantity, 5 kilo is suppose 530. You divide that by the fixed denominator and that will be 5, and then now the index is 530 divided by 5, so it's 106. So now your index will be 100, 105, 106. So you can say that the overall fruit market or the price of the fruit is increasing by 5 or 6% like that. Isn't it simple? So that's how we actually create indices. So when these stock market actually create these indices, they keep the number of stocks, as I explained earlier, the same, and they actually take certain quantity to bring it to 100, and then they keep those quantities the same so that they can actually go up. And as I was explaining, as it starts with 100 and now you can actually see how it has gone. So this is how the index is created, and that's how you can actually track and understand the stock market indices. Well, a little bit I like to introduce as well that, as I talked about the shares in the previous video, I'll talk a little bit about mutual funds, index funds, etc. So shares are for those guys who are really into that, who understand what share is, what share trading is, how the share market works. But if you are very new to this world, to this investing world, you can also go through the mutual fund if you don't understand how to select a company. And I'll make a separate video on that, how to value a company, how to pick companies which are profitable. And that requires a little bit of a finance acumen, but I'll cover that. But for some of you who are fearful, not going into the market and buying things straight away without knowing it, you can actually invest in mutual funds. So mutual funds are actually the funds managed by the professionals. So instead of directly investing in the stocks, you can actually buy these funds who are managed by professionals, and they know what they are doing. They manage it in a much better way, and generally for the novice, the returns in the mutual fund is much better. And if I have to give a number, it can vary from different funds, but roughly you can get a much better return than a novice who will manage their stocks directly. Well, so these mutual funds are the ones where you can actually invest if you don't want to get into the stock market straight away, till you learn about it, and then you can start. There's another one, exchange traded funds as well. So one is the mutual fund. The value of those mutual funds are huge. They're in billions and trillions of dollars. But there are also some exchange traded funds. There are some small funds who replicate some of those. For an example, if you're not living in India and you want to invest in Indian stock market, you can actually buy an ETF, exchange traded fund of Indian stocks. You can buy an ETF of NASDAQ directly, without directly investing in the NASDAQ or in the US mutual fund. You can be in Australia and you can buy an ETF for NASDAQ. So what will it do? It will replicate the movement of NASDAQ. So if NASDAQ has gone up 10%, you can assume that your EFT value will also go 10% up. So that's another good way to invest in stock market. Third, and the most important, that's kind of the recent one, is the index funds. These index funds are actually replicating the index one-to-one. So unlike the different funds where the fund manager has the liberty to pick and choose stocks, I'll repeat that for you. So in a mutual fund, suppose I'm managing a mutual fund, I'm the chief investment officer of a mutual fund, I have the flexibility of choosing different stocks based on my own judgment, based on my own analysis. Whereas in the index fund, I will have to map one-to-one. So for an example, if NASDAQ is trading at around say 14,000, I have to create my fund, index fund, in such a way that it will mirror, it will exactly replicate NASDAQ. So if NASDAQ goes up 2% tomorrow, my fund should also go up 2%. So in simple terms, if you want to invest in any particular country, you can buy the index fund. You don't even have to track your fund on a daily basis. You can actually see the TV or the newspaper or whatever, and you can see how much NASDAQ has gone up, for example, in this matter, and you can understand that how much your fund has gone up. And trust me, many of the fund managers are not able to beat the index. And there was a bet with Warren Buffett, who actually said that it's very hard for even the smartest fund manager to beat the index. And they actually had a bet for 10 years. And guess what? All the large mutual fund and the fund managers of USA, they actually participated in that. And after 10 years, who won? Warren Buffett. Because none of them were able to beat the index. So that's the beauty of the index, guys. That's the beauty of the index fund. But having said that, if you are investing in the index fund or the mutual fund, you will miss the excitement of understanding the companies, choosing your companies, and being the owner of those companies. And that's the difference. So my recommendation is you should learn about the companies, you should learn about how to invest, and I'm there to teach you how to do that. In my next section, I will talk about creating a portfolio or asset allocation, as it's called. The financial assets can be multiple. It can be property, it can be shares, it can be gold, and nowadays it can be crypto as well. So if you have, say, $100,000, how are you going to allocate that 100,000 in multiple asset classes? And that's what is called asset allocation. Well, stay tuned for my next video where I'll be talking about asset allocation and portfolio creation. If I've given all these examples of some of those indices and stocks, those are my personal opinion. Before investing, don't forget to consult your financial advisor. Remember, Sinhanomics is out there to create financial awareness so that you can understand the companies you want to invest in, make your own decisions, and make money. With that, if you like this kind of content, don't forget to like, share, and subscribe. I'll come back again with another interesting video for you. Till then, it's a goodbye from your finance coach, Pankaj Sinha. Bye-bye.